Hi, everyone. This is Samantha from the Law Offices of Samantha Wolfe, and I'm here for this month's virtual seminar, which is always my favorite type of virtual seminars where we're going to get to talk about taxes. So I hope you all are excited about that. You may have seen a lot of coverage lately on the big beautiful bill or whatever they were calling it in the media. And so I thought it would be nice for us to just hit the highlights and how I see it affecting clients that we have. So today we're going to dive into one big beautiful bill and highlight what you need to know about it. And let me go ahead and share my screen so we can do that. Okay, here we are. Thank you for joining us. I really appreciate it. We try to do virtual seminars for our clients, and you can always access them on our website or on our YouTube channel as you want additional information. So today is one big, beautiful bill. I'm excited about it. Okay, we have our mission statement. I just wanted to throw this up there. It's been a while since I included it in our virtual seminars. So we just have a commitment to making sure that we're getting out information to our clients and to our referral sources. We do feel like it's part of our job to make sure that we're staying current on the law. So that's why we like to do these virtual seminars. We hope you enjoy them. So today we're going to talk about what was in the big beautiful bill. So here are some highlights, and then I'm going to go into some specifics. So enhanced standard deductions, federal estate tax exemption, charitable contribution limits, temporary senior deduction, the ability to deduct interest on new vehicle loans, no tax on tips or overtime, and the new Trump accounts. And before we kind of dive into each of these topics, just as an overview, a lot of what happens, if you read the behind the scenes of the tax bills, a lot of what happens is there's obviously the two different parties and they're trying to figure out the best way to kind of come together and agree to these things. But a lot of it is budgetary. And so if they include certain provisions, it means they have to pay for certain provisions. So if they give certain tax breaks in certain areas or just certain tax groups, then you might see a law change somewhere else to attempt to pay for those tax breaks. And that's kind of what we saw in the one big beautiful bill. We saw certain groups getting some benefits, other groups maybe having to pay for that, and so we see some changes there. So I wanted to kind of cover it across the board just so we had a comprehensive overview of it. But let's talk about the enhanced standard deductions. The reason why the big beautiful bill was so important is that when Trump was in office for the first term that he was in, he passed in 2017 a tax bill, and we're still under a lot of those tax rules now. But the issue is that in order to pay for that tax bill and in order to get it to pass, there were certain provisions of it that were scheduled to sunset at the end of 2025. So when he was elected, one of the big agenda items was to figure out how to address these sunsets. And thank goodness, I will say this, the positive is that this was passed in July. So we have plenty of time before the end of the year to kind of work through what these different provisions mean. In the past, I have seen tax bills come in, I think one year it was December 17th. And so it was like we were scrambling. We had an idea of what we needed to do, and then it was like they passed it and extended some things. So I was actually relieved that we got some clarity in July as opposed to waiting to the end of the year. So that was one positive of the one big beautiful tax bill. So a lot of this is in response to the bill that was passed in Trump's first term. So let's talk about one big beautiful bill. And the first thing that I see and how it impacts our clients is it increased the standard deduction for all filers starting in 2025. So I'll try to be clear about when some of this starts, because some of it's 2025, some of it takes effect 2026, some of it is permanent. And I use that in quotations because it's permanent as long as we have this current Congress and president. They can always change it, as a new administration comes in. So some of it was made permanent, some of it has some sunsets in it. So we'll go over all of that. But no, for single filers and married couples filing separately, we saw some increase in the standard deduction. So it went from $15,000 to $15,750. For married couples filing jointly, it increased to $31,500, and that's an up or an increase from the $30,000. And for those filing as head of the household, it increased to $23,625, and that's up from $22,500. So across the board, increase in standard deduction. Though the other thing, the one big beautiful bill did, is it was marketed as no tax on Social Security, but it actually looks a little bit different than that as it plays out in real life. So it introduces a new temporary deduction. So it's a deduction. It's not meaning you don't have to include your Social Security in your adjusted gross income. It just gives you a temporary deduction for seniors that's separate from the standard deduction. Now, this has a sunset. It's only through 2028. So I think the hope is going to be that as we see these years unfold, there's a push to extend this beyond 2028. But for right now, we only have it till 2028. And it's for taxpayers who are over the age of 65. They can take an additional separate deduction of up to $6,000 depending on their income level. So again, it's not that you don't have to include your Social Security in your income. It's just that we're going to get a temporary deduction of $6,000 that you can take off. Okay, so again, it was marketed as a no tax on Social Security, but in reality, that's not what it actually is. So I wanted to make that clear. We're going to talk about this one in a little more detail in a couple of slides, but this affects a lot of our clients. So in theory, if this plays out the way they think it does, because you have a deduction, it should mean that a good portion of your Social Security should not be taxed. And that's $6,000 for a single individual or $12,000 for a married couple. So again, some of your Social Security is still going to be taxed if you have Social Security in excess of that. Okay, the next thing we saw is the federal estate tax exemption. So in 2025, the federal estate tax exemption is $13.99 million. Every individual has that. So as a married couple, you can combine that. That was scheduled to sunset at the end of this year, and when it sunsetted, or when it was scheduled to sunset, starting in 2026, it was going to revert back to the $5 million exemption. Now, it would have been adjusted for inflation, so they were anticipating that each individual would get about $7 million for the federal estate tax exemption, but in one big beautiful bill, they increased it to $15 million. Now, again, this is one of those permanent, meaning as long as we have the current Congress and president, they're not going to be adjusting this, but any new administration that comes in could adjust this. But we know starting in January of 2026, it will be $15 million per individual. Couples who are married will be able to pass $30 million to their beneficiaries free of federal estate tax. And that's a big deal because the federal estate tax is 40%. So if we had seen it sunset, it would have affected some taxpayers and they would have paid it 40%. What does this mean for the estate planning? And when I'm saying that, I'm talking about the federal estate tax exemption. So it does mean that if you are someone who gifts or is high net worth, you might want to top off gifts. You may want to make an increase. So if you've already made previous significant gifts, it now has increased the exemption. So you're allowed to gift the difference of what you've previously gifted and what the exemption will be in 2026. It also means if you haven't gifted yet, you might want to. So gifts to the next generation would remove that asset from your taxable estate and then could go to the next generation. So you might want to be doing that now that we have some clarity on what's happening with the federal estate tax exemption. It also would give you the opportunity, if you do want to make larger gifts, to kind of see how your children react to receiving the money. So that's would be something to consider. You want to consider charitable planning. So if you have a lot of money, and we're going to see a shift from federal estate tax planning to income tax planning. And so we might see clients do more of charitable trusts or charitable planning so that they can get an income tax deduction as opposed to a federal estate tax deduction. And then if you are considered making a charitable gift, you just know that you can do it anonymously. You know, you don't have to have it tied to your name if you don't want to. Okay, let's talk about another area that we saw some changes, and that was with the charitable contribution limits. So we saw two changes related to this. So one of them affects those taxpayers who take the standard deduction. So, and that's the majority of Americans. So the majority of Americans use the standard deduction, they do not itemize. So if a taxpayer uses the standard deduction, it used to be that you couldn't take any charitable contributions because charitable contributions only were permitted if you itemized. Well, starting under the big beautiful bill, we now have where taxpayers can take $1,000 charitable contribution, $2,000 if they're filing jointly, and we hadn't seen that before. So again, previously you couldn't take a charitable contribution unless you itemized. Now, if you are a person who uses the standard deduction, you can still deduct $1,000 or $2,000 if you're filing jointly. I don't know if this is going to encourage people to be more charitably minded, but I do think it's nice that taxpayers who wouldn't normally get a charitable deduction now have that ability to receive that. Now, the other way we saw the change is, like I talked about, when we give tax breaks to certain groups, usually it means we have to pay for it elsewhere. So the way that this bill worked is that, yes, we now have charitable contributions for those who are taking the standard deduction, but individual taxpayers who itemize are now going to have a 0.5% figure. So how it works is individual taxpayers who do itemize must exceed 0.5% of their adjusted gross income before any charitable donation qualifies for the deduction. So it used to be there was no floor structure if you were itemizing, and here it creates a threshold before deductions apply. And so I have an example here. If your adjusted gross income is $500,000, the first $2,500 of charitable contributions, and the reason we got the $2,500 is we took $500,000 and we figured out what 0.5% of that is, and that's $2,500. So the first $2,500 would not be deductible. If you give above that amount, then you can take the charitable deduction. So if you contributed $10,000 to charity, $7,500 would be deducted or would be deductible. The other $2,500 would not be because it didn't meet that 0.5 threshold. For C corporations, which are allowed a charitable deduction of up to 10% of taxable income, the bill limits the deduction to gifts that exceed 1% of the corporation's taxable income. So I think we're seeing this as a way to pay for the charitable contributions for standard deduction taxpayers. So again, if you are a taxpayer who takes advantage of the standard deduction, you can now deduct up to $1,000 individually or $2,000 if you're filing jointly. But if you are an itemizer, you can only deduct anything that exceeds 0.5% of your adjusted gross income. So those are the changes we see with the charitable contribution limits. We also are seeing an overall limit on itemized deductions. So this starts in 2026. And for those taxpayers who itemize, we're going to see reduced itemized deductions by the lesser of, this is where it gets fun, I don't understand how they pick their numbers, but 2/37 of total itemized deductions, or 2/37 of the amount by which the taxable income plus your total itemized deductions exceeds the 37% bracket. So when I'm reading articles on it, it seems like it amounts to about 5.5% roughly. So if you're an itemizer, you're going to reduce your overall itemized deductions by about 5.5% is what they're saying. So again, I think this is a way to pay for some of the tax breaks that we see in the big beautiful bill, is we're going to limit the itemized deductions that those taxpayers can take. Why they pick 2/37, I have no idea. But again, roughly it's about 5.5% around there. So they would have to reduce those itemized deductions by about 5.5%. Let's talk a little bit more about the temporary senior deduction. So this is talking about And remember, this one, it actually says 2026, so it goes up to 2028 is the cutoff of this. So it allows seniors age 65 and older to claim up to $6,000 per individual or $12,000 for a married couple filing jointly. This deduction is an addition to the current standard deductions for seniors. It's available for taxpayers that itemize and those that do not itemize. And this deduction phases out for taxpayers with modified adjusted gross income over $75,000 if you're single and $150,000 if you're married filing jointly. So again, media coverage was kind of touting this as the no tax on Social Security, but that's actually not true. Social Security is still taxed. It's just that you get a deduction of either $6,000 or $12,000. So in theory, the hope is that a good portion of your Social Security would not be taxable, if that makes sense. So they put it in the form of a deduction as opposed to just excluding Social Security. And again, this is only through 2028. Stops then. And then they would have to renew this provision if they wanted to. Okay, let's talk about deducting interest on new vehicle loans. So this was an interesting provision. So effective for 2025 through 2028, so this is another one that has a sunset in it. Individuals may deduct interest paid on a loan used to purchase a qualified vehicle, provided the vehicle is purchased for personal use and meets other eligibility requirements. So for example, lease payments do not apply. The maximum annual deduction is $10,000 for this, and the deduction phases out for taxpayers that have a modified adjusted gross income over $100,000, or if you're joint filing, it's $200,000. Qualified interest. So in order to qualify for the deduction, the interest must be paid on a loan that is originated after December 31st of 2024. It's used to purchase a vehicle, the original use of which starts with the taxpayer. Used vehicles don't apply. And it has to be a personal use vehicle, not for business or commercial use, and secured by a lien on the vehicle. So I think this is motivated, or it originates from an attempt to kind of spur the car buying area of the market. If a qualifying vehicle loan is later refinanced, interest paid on the refinanced amount is generally eligible for the deduction. Qualified vehicle is a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds and that has undergone final assembly in the United States. Final assembly in the United States means the location of final assembly will be listed on the vehicle information label attached to each vehicle on a dealer's premises. And alternatively, taxpayers may rely on the vehicle's plant manufacturer as reported in the VIN, to determine whether a vehicle has undergone final assembly in the United States. Taxpayer eligibility. Deduction is available for both taxpayers that itemize and that have the standard deduction. The taxpayer must include the VIN number of the qualified vehicle in the tax return for any year in which the deduction is claimed. And lenders or other recipients of qualified interest must file information returns with the IRS and furnish statements to taxpayers showing the total amount of interest received during the taxable year. The IRS is or will supposed to provide transition relief for the tax year 2025 for interest recipients subject to the new reporting requirements. So again, this is something new designed to encourage people to buy new vehicles. And so you would get the ability to deduct the interest up to $10,000. So interesting thought. Okay, let's go to no tax on tips. So again, it's kind of like the no tax on Social Security. There was a no tax on tips, and there was a no tax on overtime. And the big beautiful bill addressed all of those slightly differently for each one, but this one, it's effective for 2025 through 2028. So again, it's temporary. There is a sunset. It's for employees, self-employed individuals. They may deduct qualified tips received in occupations that are listed by their IRS as customarily and regularly receiving tips on or before December 31st, 2024, and that are reported on a Form W-2, Form 1099, or other specified statements furnished to the individual or reported directly by the individual on Form 4137. What's interesting to me about this is that a lot of tips are paid in cash, so you don't necessarily have it reported on a W-2 or a Form 1099. So that's what's interesting to me. Now, when it talks about customarily and regularly receiving tips, that's important too. Like, you can't all of a sudden switch to tipping for things that you didn't normally tip in an attempt to circumvent having to pay taxes on it. So qualified tips are voluntary cash or charge tips received from customers or through tip sharing. Maximum annual deduction is $25,000, and then for self-employed, deductions may not exceed an individual's net income without regard to this deduction from the trade or business in which the tips were earned. Deduction phases out for taxpayers with modified adjusted gross income over $150,000 or $300,000 for a joint filer. And the taxpayer's eligibility is the deduction is available for both itemizers and standard deduction taxpayers. Self-employed individuals in a specified service trade or business under Section 199A are not eligible. Employees whose employer is on the specified service trader business are also not eligible. Taxpayers must include their Social Security number on their return and file jointly if married to claim the deduction. You don't get this if you're married filing separately. Employers and other payers must file information returns with the IRS and furnish statements to taxpayers showing certain cash tips received and the occupation of the tip recipient. So by October 2nd, 2025, the IRS is going to publish a list of occupations that customarily and regularly receive tips on or before December 31st of 2024. So we're waiting on that guidance. And the IRS will provide transition relief for tax year 2025 for taxpayers claiming the deduction and for employers and payers subject to the new reporting requirements. So a lot of this, we have to see how it unfolds with the guidance by the IRS. No tax on overtime. So here's another one. So another one that has a sunset. It is a new deduction. It's effective for 2025 through 2028, and then it's no longer able to be used. It's individuals who receive qualified overtime compensation. They may deduct the pay that exceeds the regular rate of pay, such as the half portion of time and a half compensation that is required by the Fair Labor Standards Act, and that is reported on a Form W-2, a 1099, or other specified statement furnished to the individual. The maximum annual deduction is $12,500 or $25,000 for a joint filer. The deduction phases out for taxpayers with modified adjusted gross income of over $150,000 or $300,000 for joint filers. A taxpayer's eligibility is going to be available for both itemizers and standard deduction taxpayers. Taxpayers must include their Social Security number on the return, file jointly if married. So again, if you're married filing separately, you don't get this deduction. And employers and other payers are required to file information returns with the IRS and furnish statements showing the total amount of qualified overtime compensation. The IRS will provide transition relief for tax years 2025 for taxpayers. So again, the IRS is going to have to be doing a lot in order to make all of these things work. Okay. I think this is our last one that we're going to cover that I think affects our clients, and this is the Trump accounts, or sometimes they're called the Magna accounts. So what are they? The Trump accounts are custodial savings and investment accounts that can be established for U.S. children under the age of 18 and to encourage long-term financial security. Contributions are made on an after-tax basis. So what that means is that if I have a client that has a child and they want to set up this Trump account, they're already going to have paid income tax on the money that they're using to fund the account. And then the investments do grow tax deferred until they're withdrawn. So for example, if I would contribute $10,000, I've already paid the income tax on that $10,000. I put it into this Trump account. It will grow tax free, but withdrawals will then start happening at age 18. And once the withdrawals start happening, there will be tax at that time. So it's a lot like an IRA in that sense, that it grows tax-free, but then when you have to start withdrawing it, you're going to pay income tax on it. Withdrawals are generally prohibited until the year the child reaches the age of 18, and these are specifically targeted towards children. Who's eligible? Beginning July 2026, Trump accounts can be established. And I believe this is actually, I think it's 2025. So I think that's a typo there. They can be established for children who are U.S. citizens, have a valid Social Security number, and are under the age of 18. The new law creates a pilot program. Qualified account holders born between January 1st of 2025 and December 31st of 2028 are eligible for a one-time government contribution of $1,000. For children born outside the U.S. during the 2025 to 2028 timeframe, but who are still under the age of 18, qualify for a Trump account. However, they won't get that $1,000 seed money. Trump accounts do not have income limits or restrictions. Now, in order to get this $1,000 that the government is saying they'll contribute, you have to set up the account and also contribute. Like, the government's not just going to set up the account for any children that are born and contribute the $1,000. You actually have to set up the account and then contribute the money, and the government will put in $1,000. So, continuing this line of thought, let's talk about what are the limits that can be contributed. So parents, relatives, and others can contribute up to $5,000 per child annually. So I should say, when I was giving the example of the $10,000, that would mean I would have to have 2 children, $5,000 to each child if I was making the contribution. The cap will be adjusted for inflation in future years. Employers are able to set up plans under which contributions may be made to employees' Trump accounts or the Trump accounts of employees' dependents. Contributions up to $2,500 annually for each employee. And I think the one benefit there would be that that's not included as income for the employee if the employer makes the contribution. Charities and government entities may also make contributions to Trump accounts under certain conditions. So any contribution by charities and government entities do not count towards the $5,000 annual limit, and the $2,000 federal contribution is excluded from the $5,000 limit. So it'll be interesting to see how these play out. I know that I've seen a lot of articles on the feasibility of setting this up, making it workable, all of that. But this is what's in the big, beautiful bill. So what's the tax treatment for these accounts? Contributions made from individuals are made with after-tax dollars, meaning they're not deductible, but will eventually be able to be withdrawn. Employer, charitable, government contributions, including the 1,000 seed, are not considered income at the time of contribution is made, but will be included in income upon distribution. Earnings on all contributions grow tax deferred. When the individual reaches age 18 is able to take distributions, the account may contact funds that are not taxable upon distribution and the amounts that are taxable upon distribution. The same rules that apply to IRAs also apply to Trump accounts. So this is where it gets a little bit confusing. So there's going to be a certain portion of it that is tax-free and a certain portion of it where you're going to have to pay tax on. It all depends on who is making the contribution. So again, it'll be interesting to see how the government provides guidance on this or how they actually administer it. But we'll see. This is what is in the bill. How are the funds invested? They're automatically invested in a mutual fund or exchange trade fund that tracks the returns of qualified index, such as one tracking the S&P 500. Account holders cannot choose between multiple funds or adjust the investment mix, and the allocation is fixed and limited to U.S. equities, meaning you can't do anything overseas. Funds must have annual fees higher than 0.1%. What's next? Like so much of what we talked about today, the IRS is expected to issue additional regulations and guidance that clarify details of the new tax law. All investing involves risk, including possible loss, and there's no guarantee that any investment strategy will be successful. So again, we'll have to see how these unfold. But it was interesting to me. I always like it when we have a new tax bill to be able to go through it and see what's in there, how it applies to our clients. Next steps for those of you watching this would be to call our office at 717-655-2676 to schedule an initial consultation. We're always happy to talk about all these fun tax things. And again, we'll keep an eye on how these tax provisions are implemented, since we're waiting on so much guidance from the IRS on them. So, but thank you so much for joining me. When I saw that we were getting a new tax bill, there was a part of me that was really excited, because it's always fun to kind of see what new changes we have. So I appreciate watching this. This was one big, beautiful bill where we overviewed the highlights, or tried to highlight the provisions of the tax law that would affect most of our clients, or some of our clients. So if you have questions, like I said, always feel free to reach out. You can access our YouTube videos directly from our website. We put links to our YouTube channel. We also update our website with our quarterly newsletter. So if you want to check that out, you can do that. Or you can jump over to our YouTube channel and you can actually see all our videos. So I am Samantha Wolfe with the Law Offices of Samantha Wolfe. Thank you so much for joining us. I hope you enjoyed learning about the big, beautiful bill. And we're here if you have any questions or concerns. We'll see you next time. Thank you.